Now, even though this week has been a red day in the market and my portfolio has lost $532 in value since my why I sold 50% of my stocks video, I feel like celebrating because today, at the time of recording, which is September 6th, it marks my 2 years of investing in the stock market. So while most people would be out celebrating this momentous occasion, by going to Burning Man or partying it up like there's not a global pandemic still going on, I look back on my 2 years of investing, and in today's video, I'm going to reveal my portfolio's 2-year performance and whether I should just quit picking individual stocks and just follow Warren Buffett's advice and buy into index funds. I actually started investing in the stock market around 2013 with Scottrade and moved over to Robinhood in 2016. And by investing in these two initial platforms, I've learned a lot and it strengthened my risk tolerance to the overall market. I mean, when I was just started investing, I used to sell out entirely if the stock I was holding went down to 1%. But, most recently when the market dropped 30 to 50% in March, I didn't end up selling. If there's anything that the stock market teaches you is to have a very strong stomach. So why do I say that I'm marking my 2 years of investing when I've started investing back in 2013? Is because those initial investments with Scottrade and Robinhood, I don't really count those as investing. If anything, it was more of speculative gambling without any proper research done on my part. And you know what I'm talking about if you saw this video about me going over my past Robinhood trades and how much money I've missed out on by selling out of Netflix and Apple and other stocks way too early. And spoilers, so you don't have to watch that video, it basically amounted to several $1,000s. In any case, September 5th of 2018 was the fateful day that I decided to start, brand new with more education and more research on my part with M1 Finance. And I deposited $500 to open a Roth IRA account with M1 Finance. And the very next day, September 6th of 2018, I made my first massive investment of $20 into 92 different companies. And because of fractional shares, I ended up buying only 20 cents per company. But I did end up putting more money into some companies I really believed in. For example, I believed in Tesla so much back in the day that I decided to put a whole 40 cents into it. And look at that share price, $289, and that was pre-stock split price. So you can say that I was investing in Tesla before it was cool. One of the biggest reasons I switched over to M1 Finance from Robinhood was because, like I mentioned, I was able to buy fractional shares, which allowed me to invest in companies that I really wanted to, like Amazon and Alphabet. And even though many brokerages now, they allow fractional shares, which is great, back then it wasn't the case. And on that note, let me just say all your stock newbies who are just starting in investing with these commission-free brokers like M1 Finance, Robinhood, and Webull, you should really be grateful because when I first started trading with Scottrade, I had to pay $6.95 every time I wanted to execute a trade. I mean, just imagine the commission fee I would have had to pay for making all of these trades I'm showing you with M1 Finance. To put into perspective, in 2018, I made a total of 5,945 trades with M1 Finance. And if I had to pay the Scottrade commission fee of $6.95 per trade, the commission fee I had to pay just for 2018 would have totaled $41,317.75. So needless to say, I'm very happy I don't have to worry about commission fees anymore. And you guys should be very happy that commission fees are no longer a thing. And I know it makes me sound old when I say all these things. It's basically saying, back in my day, we actually had to talk to people to buy and sell stocks. And of course, M1 Finance, it isn't perfect, and I break down the pros and cons of the M1 Finance brokerage in this video. But I've been very happy with the platform so far, so I'll be sticking with M1 Finance and giving you guys my retirement portfolio updates with M1 Finance. Of course, if something better comes along, I'll definitely make a switch like I did with Robinhood to M1. But enough rambling, let's get right into the numbers. I'm going to start off with the dividends that I've earned over the 2 years because unfortunately it's not that impressive compared to other financial YouTubers who focus on dividend income. Like I mentioned in this video, I changed my stock allocations and sold off half of my initial holdings. Now I hold 25 companies and the majority of them are now skewed towards growth stocks. And if you're all about getting that dividend income, go ahead. But the reason why I'm not choosing to focus on dividends, at least right now, is because let's say even if I get 5% dividend yield, which is crazy high, I'm only going to get $1,141 per year, or $4.50 for every trading day. I'm sure that's a very decent chunk of change, but getting that $4.50 a day, it means the opportunity cost of investing in companies that has the potential to grow faster and appreciate faster thanks to market price appreciation. And sure, growth stocks, they carry more risk than dividend stocks or value stocks, but my goal right now is to grow my portfolio as quickly as possible. Besides, I do get some dividends thanks to my, even though it's very small, 1.179 dividend yield, so I'm not complaining. In any case, over the past 2 years, the total dividend I've collected from all of my past and current holdings is $218.46. And thanks to M1 Finance algorithm Black Magic, I just, set it and forget it and then auto-invest whatever dividend comes into my portfolio. So that was basically my small dividend amount that I earned. And now, let's jump into my Google Sheets where I break down everything about my stock market portfolio. All you number nerds are gonna love this. And yes, I did add some pop of red because, why not? This previous column, it contains information of when I filmed my Why I'm Selling video. And of course, the today column is going to show the information of filming, as of today, which is September 6th. And because of the stock market sell-off led by the tech stocks, my portfolio has gone down $532, or it has shrunk by 2.28%. But like I mentioned, if it was during my initial stages, I would be hyperventilating and selling all stocks just so I can lock in my losses. But after 2 years of investing and having grown a stronger stomach, I'm basically loving it. I love it when the market sells off because it basically means that the stocks I really want to invest in, they're going on sale. And along with updating my colors for my Google Sheets, I added this new row which shows my uninvested cash within M1 Finance. And I like to keep between 10 to 30% of my portfolio in cash, but pick whatever percentage works for you. But the reason why I hold 10 to 30% of my portfolio in cash is because of these market corrections and the stock sell-offs that we're going to get occasionally. If you don't have any cash on the sideline, how are you going to take advantage of these stock sell-offs? That's why you should always have some cash so you can take advantage of these red days. Typically, I like to dollar cost average $165 a week into my portfolio, regardless of if the market is up or down. But as you can see, I put in $275 at least this week because of the stock market sell-off. And as long as it continues to go down, I'll keep on putting in more than $165 per week so I can take advantage of the stock market sale. So remember, as always, when it comes to investing, it pays to do the opposite of what everyone else is doing. When the crowd is selling because of the tech stock going down, you should continue to buy, as long as you still believe in the companies that you're choosing to invest in. And honestly, I'm actually glad that we're going through this bit of a sell-off because the market has gone really hot really quickly, even though we haven't received any good news in terms of vaccinations for the coronavirus, etc. Hopefully the sell-off will bring the market a bit more in line with its true value and not just stay elevated because people are just buying into this euphoric optimism. The last thing I want to end my video on is to basically show you how my portfolio has performed since I started 2 years ago. To be more transparent, I created these two different results because once again, I'm never fully 100% invested because I hold 10 to 30% of my portfolio holding in cash, and I wanted to showcase my returns more according to whether I have the cash invested and whether I have the cash not invested. And the category titles basically tells you everything, but the market gains with cash shows my portfolio return as a whole, including my cash pile, while this row shows the return without including my cash pile. So thanks to this sell-off that we're going through right now, my market gains with cash is more in line with the average stock market return between 8% to 10%. We just take the percentage and just divide by 2 because this is over 2 years. But if I leave out and don't consider my uninvested cash, I'm beating the stock market average with an annualized return of 12.52%. And in my previous video, in this video, I talked about the power of compounding and how my portfolio is going to grow from what it stands right now to $2.6 million if it returns the average stock market return of 10%. But if I take my actual return of 12.52 that I've just calculated, my portfolio isn't going to grow to 2.6 million. Instead, it's going to grow into $4.5 million. This is why stock picking can be so addictive, because even a slight beat over the S&P, the average stock market index, it means your portfolio is going to compound that much quicker and your portfolio's total is going to be that much bigger and stronger. With all that said, it's never really certain what the portfolio amount is going to be by the time I reach my retirement age, but hopefully my stock picking skills is going to allow me to, outpace a typical stock market index fund. So for right now, I'll have to apologize to Mr. Warren Buffett and go against what he says, because this stubborn investor, he's going to be choosing his own stocks. But what do you think? Let me know if you think that I'll be able to beat the result of just buying into an index fund, or just do what the Oracle of Omaha says and just invest into an index fund. Leave your response down below in the comment section. But to wrap everything up, all in all, I'm pretty happy with the results I've gotten over my 2 years of investing with M1 Finance. And I know my market gains and the result, it will be more impressive if I had stayed more consistent with my investing style from the start. Because like I showed, my very first trade was I bought 92 different companies. So even though it offered me a lot of diversification, it really limited my growth potential. And the past 2 years, it's been a learning process, and I did switch back and forth between, totally 100% in individual stocks to just 100% into Vanguard ETFs, messing with different percentages and buying in and out of different stocks. So it wasn't as clean cut as I would have liked. And I discovered this is one of the downsides of commission-free trading, because since there's no fee associated with making a trade of buying or selling a position, there's no financial consequences that makes you think twice about whether I should sell this or whether I should buy this before, submitting and clicking away. As a result, I feel like nowadays investors are quicker to buy and sell, which leads to short-term capital gains or short-term capital loss, and it doesn't allow them to develop their investing style. Because, when you first start investing, it is pretty daunting because there's just so many companies and investing styles to choose from. But I like to just say the key thing is to experiment. That's why I always recommend starting off investing with a small amount so you can, test out the water, try different investing techniques like value investing, growth investing, or dividend investing. And the more you research and you buy different companies and you see how the stock market goes up and down depending on the micro and macroeconomic trends, you're going to be able to fine-tune which companies and which categories and which sectors is going to work for you, and it's going to align more with your risk tolerance, and which investment method is going to work for you as well. Like I said, after 2 years of figuring out what I wanted and how I wanted to invest, I'm leaning more towards growth stocks right now with my 25 holdings that I have, because I want my portfolio to grow faster with stock market appreciation. But of course, I'll naturally transition more to income generating stocks as my portfolio gets larger and as I get closer to my retirement age. But for now, this was the behind the scenes of my 2 years of investings. And as always, if you appreciate the amount of transparency I try to bring with my videos, don't forget to like, comment, and subscribe as the offerings to the YouTube gods, because it's going to help grow my channel much faster. My current goal as of right now is to reach 500 subscribers by the end of the year, so we'll see where I stand when it comes December 31st. As always, if you haven't already but want to get started on your investment journey, check out my M1 referral links down in the description to get your free $10 when you sign up and fund your free account. Links are also there for Webull, where you'll get 2 free stocks when you open and fund your account, $100. And finally, there's going to be links to Robinhood to get your 3rd free stock. Thank you so much for stopping by. Happy investing, and I'll catch you next time with more shenanigans.